Okay, so let us see this. Now, monetary system in India, this is something that we are going to cover. Here, the most basic functions of RBI also will become part of it. Okay, and some other elementary information, the basic information. So the first such information is this, that what is the system that we follow in terms of printing of currency in India? That is, we call minimum reserve system. Okay, minimum reserve system. Minimum reserve system means that you have just studied about money supply and total money supply in the economy, because money supply is a stock variable, can be measured at a point of time. And at present, today it stands somewhere around 165 lakh crore rupees. Okay, so does it mean that RBI is going to maintain 166 or 65 lakh crore rupees worth of bullion with it, or means, is it backed by equivalent amount of bullion? Is it backed by gold? Is it backed by foreign securities, or is it backed by government securities, equivalent amount of government securities and all? No, that is a system that we used to have when there was proportional reserve system. But now we have minimum reserve system in India. And what is minimum reserve system? Means RBI has to maintain minimum reserves. What is that minimum reserve? This is 200 crore rupees of minimum reserve that it has to maintain, mainly in form of gold and foreign securities. Gold and foreign securities. Now, out of 200 crore rupees minimum reserve, 115 crore rupees should be maintained in form of gold, and rest can be in form of foreign securities. So foreign securities may have forex, foreign reserves. Okay, it can have SDRs and other things. Okay, so two things here: the gold and foreign securities. So this has to be maintained in form of these particular components, and this is the minimum reserve requirement. Okay, now understand that when it comes to the total amount of money that RBI can go on printing, that depends upon this minimum reserve, that is 200 crore rupees of gold and foreign securities. And the third component, if I add, and that is government securities, GSECs, okay, government securities. And against the backing, and this is the minimum reserve component, and this is the third component. Okay, third component. Now I'm saying that if you want to know that what is the amount of money that a government can RBI can go on printing, then RBI, virtually speaking, can go on printing unlimited amount of money against the backing of this minimum reserve, consisted of gold, 115 crore rupees minimum, then foreign securities and government securities. RBI, virtually speaking, can go on printing unlimited amount of money against the backing of gold, that is a component of minimum reserves, then foreign security, again the component of minimum reserves, and government security. Okay, so this is something that you need to know. Okay, this has been given here. Okay, so in India, currency is printed as per the provisions of minimum reserve system. It was adopted in 1956. Before that, we have proportional reserve system, that RBI has to maintain proportionate or the equivalent amount of bullion and foreign securities. Okay, then under MRS, RBI has to maintain reserves of at least 200 crore rupees of uh, of reserves in form of gold and foreign securities, out of which this much, that is 115 crore rupees, should be of gold. Now, these datas are not important. What is important is the concept. Okay, this particular information, that is, it is the proportional reserve system which is maintained in India, and not the I'm sorry, it is the minimum reserve system which is maintained in India, and not the proportional reserve system. Okay, so this information is important. Then RBI is empowered to print currency against the backing of gold, foreign securities and the securities of government of India. That is something that I already told you. Okay. Now understand that initially in India, and other piece of information, related information I'm giving you, that what used to happen initially in the first 5-year plan and then second 5-year plans, government was having a strong sterling base. Okay, sterling base, strong sterling base. That means forex was high. Now this may surprise you. So forex reserves, the foreign reserves were high, strong sterling base. And secondly, inflation was also not there. Inflation was also not much. And that is why government used to finance its investment by printing of money. Okay, sometime asking the RBI to release the cash, to release the money from its vault. Okay, so what I'm saying here is this, that during the initial years of planning, governments used to have very ambitious investment plans. Okay, investment plans. And generally, it used to happen that government was unable to finance these investment plans by the receipts that it used to collect, mainly the revenue receipts, that they were not, government was not capable of meeting the financial uh, requirements to actually fulfill all the ambitious investment plans that it used to plan. Okay, it used to design. Now, because of high sterling base, that is high forex, and low inflation, government used to ask RBI to print money, and sometimes used to ask RBI to release money from its vault. In both cases, what used to happen? That new money was entering into the system. When the new money is printed, or when RBI is releasing certain money which is it has kept aside in its vault, in both cases what is happening, new money is entering into the market. That means there is increase in money supply. Now whether the government is asking RBI to print money, or it is asking RBI to release certain money that RBI has kept in its vault, both have been called, or both have been referred as deficit financing. Deficit financing. Okay. So in deficit financing, what used to happen? Government used to have very ambitious investment plans for development, and then it was not capable of meeting those demands. Then what it used to do? It used to go for deficit financing. Okay, so many times government used to come out with government securities that it used to offer to RBIs. Against that, RBI used to print money. Sometimes governments were not able to honor those government securities, so that led to the monetization of deficit. Monetization of deficit. Okay, so through deficit financing, governments used to finance its developmental programs. That is the information that you needed to know. Now, it is related with the concept of money supply, because you just understood that how deficit financing, that is either the printing of new money by RBI, or RBI releasing money from its vault. In both cases, both are referred as deficit financing. In both cases, what will happen? In both cases, there will be increase in the money supply in the economy. Okay? Increase in the money supply in the economy. Okay. Now, if I ask you the question that is deficit financing going to create new assets in the economy? Now, deficit financing was resorted to by the government for investment plans, for meeting the financial requirements, to fulfill the investment plans, to realize those investment plans which were designed for bringing about development in the economy. Now, are they going to create new assets in the economy? So the answer is no. Answer is no. They deficit financing as such cannot create the new assets in the economy. Why? Because, for example, This is the total number of products in the economy. Okay, and this is the total number of money, total amount of money in the economy. Now, if deficit financing is resorted as the method to meet the investment plans for the development, then what is happening? Number of products in the economy is not going to increase. What is increasing is the money in the market. Okay, so what will happen at max, that now the government is going to have more money for the same number of products which were available in the market, where private sector and the government were competing with each other to have control over those assets. Now, because of the increase in money supply, those assets in the economy will become more costlier. Okay, so they will be available now to the government as well as private sector at higher cost, at higher price, because number of products, number of assets are same. It just happened that now there is more money in the economy because of deficit financing. So deficit financing is going to increase the prices of these assets. And because now government has got RBI to print money to meet the investment plans, it is the government which is going to have more money than the private sector. So what will happen, that earlier maybe 50% of the assets were with private sector and 50% of the assets were with government sector. Now because the government has more money, because it has got RBI to print money, or it has asked RBI to release money that it has kept in the vault, because it has more money, then more assets will get transferred to the government's kitty from the private sector's kitty. So deficit financing, you must understand here, is not going to lead to the creation of new assets. There will be the transfer of assets from private to government sector. Okay, so that the new building or the new road is actually not a new asset, it is a transfer of asset from private to government sector. Okay, now again understand, deficit financing is also termed as inflation tax. Inflation tax. Why? Because what happens when deficit financing is resorted? When deficit financing is done, then there is increase in the money supply. New money becomes part of the economic system. New money enters into the market, while the number of assets in the economy remains same. And that is why those assets, those products, goods and services are going to be available at a higher cost. So deficit financing has inflationary effect in the economy, and that is why it is as if there is a kind of tax being imposed on the products, because the prices of those products is rising because of increased money supply in the economy. Okay, now too much money is changing too few goods. Inflation, simply. Getting it? You came to know what is deficit financing, that is printing of new money, or RBI releasing money from its vault. In both cases, new money is entering into the system. Secondly, you came to know, understand that deficit financing does not lead to asset creation. You understood that deficit financing is actually leading to the transfer of assets from private to the government sector, because through deficit financing, government comes to have more money in comparison to the private sector, and that is why those assets will be transferred from private to public. Okay, thirdly, you also came to know that government could afford to do so in the initial years after independence because of high sterling base, that is, we had good amount of sterling as forex in our country, and at the same time there was no inflation, so government was not actually concerned about its inflationary effect, and that is why it could do so. Okay, now understand that after the year 1991 LPG reforms, what happened? That forex increased in your country because of the liberalization. Forex, liberalization and globalization, forex increased in the in your economy. Now, the problem was that already MS, that is money supply, was very high because of the entry of dollars. So for example, foreigners are coming to India with their dollar. So what they will do? They can't spend that dollar in Indian market. So they have to go to the agency which is authorized to deal with forex, and here in our case it is RBI and its authorized agencies, and those authorized agencies are actually all the commercial banks. So those people, those foreigners, will go to RBI with their dollar to get it converted into Indian rupee, and that is something that they are going to spend in Indian market. Okay, in Indian market. So in post reform era, that is after LPZ reforms in 1991, more and more forex came to India, that is foreign reserves came to India, more and more dollar came to India, and that itself became a concern because it was continuously increasing the money supply in the market. Okay, so earlier there was less inflation, and that is why government used to resort to the method of deficit financing to finance its investment plans or developmental programs. But now in post reform era, increased money supply was already a problem because of increased forex, and that is why the issue was how to suck out extra liquidity from the market. Okay, how to suck out extra liquidity market. So instead of deficit financing, the opposite was needed in our case, that is the sterilization of Indian economy. That means that the central bank needed to suck out extra liquidity from the market. Okay, to maintain a balance, because don't you think that increased forex will actually increase or will have inflationary impact over the Indian market? Okay, because dollar is coming to India, RBI is compelled to give rupee against this dollar, then this rupee is going to be spent in India. This is the new rupee which has come into the Indian market, okay, in form of new dollar. Okay, so understand that what is the link between money supply and how deficit financing is going to increase the money supply, then how deficit financing is going to have inflationary impact, for what purpose deficit financing was used in India, that was mainly for the developmental expenditure. Then how in post-reform era another problem emerged, that is in post-reform era there was increase in forex, and that is why there was already high money supply in the economy, and that is why deficit financing is no more used to meet the requirements of developmental expenditure or the investment plans. Now sterilization of economy is done to suck out extra liquidity from the market. Okay, so this you can see here. Deficit financing, also called inflation tax. Now why it is called inflation tax, you already understood it. Okay, inflation tax. Now it has been one of the cause of increase in money supply in pre-reform era, that is before 1991. Before 1991. Okay, then in post-reform era, what happened? That MS increased due to increase in foreign exchange. That is, in post-reform era, what happened? There was high inflow of foreign reserves, and that high inflow of foreign reserves increased money in the economy, that is money supply in the economy, and that is why we needed to suck out, the central bank needed to suck out extra liquidity from the market, and that is called sterilization, which was needed here. Okay, so increase in forex may create inflation. To counter inflation, RBI may sell government bonds to suck out extra liquidity, and that process is called sterilization. Okay, so in prelims examination, these terms are also important, so take note of these terms also. Okay, so you understood what is a minimum reserve system, how it is different from proportional reserve system. Then you also understood what is deficit financing, how it is related to money supply. Okay, if you have understood this, then we can attempt these questions. For example, this question appeared in the year 2013 in India. Direct question: if you have studied economics properly, if you have understood all the concepts properly, then economy section is not going to be a problem for you. Okay, in India, deficit financing is used for raising resources for economic development, redemption of public debt, adjusting the balance of payment, reducing the foreign debt. Okay, redemption of public debt, how it can be done just by increasing the money supply? No, although we have not studied every section of economy, but if we continue increasing continue printing the money, then the value of money vis-a-vis other currency will decrease, and we will never be able to meet this redemption of public debt because many of that will be paid in different currencies or different uh, mainly different hard currencies. Then adjusting the balance of payment, again this cannot be done just by printing the money. Reducing the foreign debt, again clearly cannot be done in rupees. Okay, so what was the main purpose? I already told you that it was the economic development, that is to meet the requirement of the investment plans that government used to design. That was the major purpose. Okay, I said that it was mainly because of increase in forex. Understand, it was mainly because of increase in forex that we stopped resorting to deficit financing as a method to meet the developmental expenditure in the country. But at the same time, I said that we used to do deficit financing because of high sterling base. Understand, when I say high sterling base, I meant to say that if we kept on increasing the rupee supply in the market because of high sterling base, that means already because of the high supply of foreign currency in your country, the valuation of rupee will not be low. Okay, it will not go, it is not going to devalue your currency because of the already high supply of high reserves of sterling. Okay, but against this situation, after the year 1991, what happened? That increasingly there was inflow of forex, so new money was getting created in the economy, and that became the problem. That is why deficit financing could not be used. Okay, so that is the difference. Okay, so you understood this question? Very easy question, that in India deficit financing for uh, used for raising resources for economic development. Okay, it was not any of other the alternatives that was given. Okay, a direct question, direct conceptual question. Next, Reserve Bank of India. This topic is important from prelims point of view. Very much, very important topic. Was again, UPSC has been asking question on the functions of RBI, then uh, the very institution, how it is uh, existing in India, the Act, RBI Act 1934. So that is something that you need to uh, know properly. Okay, so the most basic information has been given here. Central Bank of the country. It is the central bank of the country, and it is apex monetary institutions. It is head by RBI governor. Now, RBI governor, the appointment of our RBI governor is governed by RBI Act, RBI Act 1934. Okay, so it says that there will be one RBI governor and not more than four deputy governors. And RBI governor, according to Act, is appointed by Prime Minister's office. Okay, is going to be appointed by Prime Minister office on the recommendation of Finance Ministry. Okay, so that is the information. Then established on the recommendation of Hilton Young Committee. Not very much important from UPSC's prelims point of view, because UPSC does not become factual to this extent. Then nationalized on 1st January 1949. Apex monetary institution. Also understand that it was established through a statute, but it was established in private sector. Okay, and it was nationalized afterwards. So it was established in 1935 through 1934 RBI Act in private sector. Okay, so no anomaly here. It was established in private sector means majority shareholding was by private sector, and it was established by the Act means there was a statute, a law which provided for this particular body. Now afterwards in 1949 it was nationalized. Okay, and it is the apex monetary institution, that means the apex institutions for monetary policy. Okay, then RBI is the sole authority to print money. Yes, it is the sole authority to print money. So all the, see, there are two things. Now, which denominations of currency will be printed, that is something which is decided by government. But which authority is there to print money? Yes, it is the sole authority which has got the right to print money. Okay, the government actually prints 1 rupee coin, 1 rupee notes and coin under Currency and Coinage Act. Okay, but higher denominations are printed only by RBI. Okay, why this is so? Because 1 rupee is actually a token legal money. Okay, token legal tender money. It is actually a token money, which is a kind of guarantee. It is an asset in itself. Okay, that is why it is not being signed by RBI governor. Okay, let us see further. Functions of RBI. It is a banker to the government. It is a banker to the government means government maintains uh, accounts with RBI, and other than being just the banker to the government, RBI is also the merchant banker of the government of India. Merchant banker would mean investment banker. Investment banker means the bank, the institution, which is the organization which is going to manage the borrowings of the government. Okay, then central and all state governments have to maintain accounts with RBI. This is another basic information. So all state governments and central government maintains accounts with RBI. Then all the financial transactions of the governments are undertaken through RBI. So as I said that it is a banker of the government, then all the financial transactions are going to be undertaken by RBI only. Then it advises the government of on financial issues. Okay, so as I said that it is a apex monetary policy institution, apex monetary institution. It is going to take control of the monetary policy of the country. Although there is a monetary policy committee, but yes, so far as any institution is concerned, this central bank of the country in any country is responsible for various monetary policy objectives. So yes, it advises on financial issues, it advises on borrowings, it advises on debts, it advises on the interest rates that need to be kept for the securities. Then it advises on the interest rate on which public borrowings can be done. So that is something that eh, it does. Okay, then it lends to government as well as manages government's borrowing program. Manages borrowing program. Again, the same point, that is, it is the investment banker of the government. Okay, through sale and purchase of government securities. Understand, two functions, two very important functions, but seemingly opposite. Understand here what I'm trying to say. I said that RBI is the apex monetary institution. Okay, when it is apex monetary institution, that means that it is an institution which is going to oversee the level of inflation in the economy and how the economic growth can be propelled, can be encouraged, employment, unemployment, then the issues related to poverty, all that depends to a good extent on monetary policy. And these all depend to a good extent on the credit availability. And credit availability is a function of interest rate. Okay, so in that sense, the institution is responsible for maintaining a definite window of interest rate or definite range of interest rate in the economy. But the same interest rate is something which is going to be used by the government when it goes for its own borrowing. Okay, so RBI is an institution which is going to decide the interest rate in the economy. At the same time, it is an institution which is managing the government's borrowing. And there, a kind of conflict of interest may arise. How? See, if government is the merchant banker or banker of the, if the RBI is the investment banker of the government, then RBI, being a very good investment banker, would try for least cost of borrowing for the government. So would try to stifle or to try to have that kind of monetary policy through which borrowings could be made available to the government at the least cost. So may change the interest rate to act as the best investment banker possible for the government. But that particular act might make the borrowings cheaply available to government but may not be good for the larger monetary policy objectives of the country. Okay, so on one hand it has to take care of the credit control measures and the interest rate to meet the larger monetary policy objectives. and on the other hand it has to manage the borrowing requirements, the borrowing programs of the government, and that raises the issue of conflict of interest. So it is suggested, or it has been suggested by different committees. For example, Sri Krishna committee also suggested on the same line that this particular job of RBI, that is, it is managing the government's borrowing program, that is something which must be taken away from RBI and should be given to any other body, for example, Public Debt Management Agency. Because again, there is an issue. See, this is mainly relevant for mains examination, but I I suspect that UPSC may ask a conceptual question on this also. Okay, so that is why I'm discussing it. When it comes to internal borrowing of the government, this is managed by monetary policy. This is managed by RBI. When it comes to external borrowing of the government, that is managed by Finance Ministry. So it is said that when it comes to borrowing of the government, borrowing requirements of the government, then there must be a body entrusted exclusively with the task of managing the borrowing, because this bifurcation is also not very good. That is, internal borrowing is managed by RBI and external borrowing is managed by Finance Ministry. So that should also be done away with. This bifurcation should also be done away with. So it is suggested that Public Debt Management Agency would be created, and that is going to oversee both the internal borrowing requirements, internal borrowing of the government, and it is also going to manage the external borrowing of the government. And if this very function, that managing the government's borrowing, that particular function, if it is taken from RBI, then there will not be any conflict of interest, because then RBI will be able to focus exclusively to attain the monetary policy objectives. Because if you have understood the conflict of interest involved here, then a clear case of dilemma exists before RBI, that if it has to act as a good investment banker of the government, then it must be able to make the borrowing available to the government at lower cost. For that, it will need to bring down the interest rate. But this may go against the larger monetary policy objectives of the country. So that is a conflict of interest. Okay, and that is why it is suggested that a separate body, that is Public Debt Management Agency, should be created to manage the both external as well as internal borrowing requirements of the country. Okay, so these are the major functions. Then other than this, you can go on citing the other functions. It is the banker's bank, that is, banks have to maintain accounts with RBI. Okay, so just like it is the banker of governments or the government banker, then it is the bankers of the banks also. So banks have to maintain their deposits with RBI. Banks are also advised by RBI. Getting it? So banks, uh, time to time, RBI comes out with various guidelines that banks have to follow, various advices that banks need to follow for proper functioning of the banking sector. Then it also lends banks in good and bad times. That is, in good times, banks will be able to manage funds from various sources, but RBI is an institution which is going to lend them at bad times also. And for this reason, it is called the lender of last resort. You might be knowing it, lender of last resort. Okay, lender of last resort. Okay, now it is also a supervisor of banks. So, for example, it is going to uh, supervise the activities of commercial banks. It is going to supervise the activities of other banks, for example, cooperative banks. It is going to oversee the mergers and acquisitions. It is going to oversee the capital adequacy norms, whether they are being maintained by the banks or not. Okay, so uh, if certain banks are planning for branch expansion, that is also something which is going to be overseen by the RBI only. Okay, then it is the supervisor of payment system also. So what will be the norms of different payment modes? So for example, RTGS is there, IMPs is there. How those mediums of payments are going to be uh, followed, conducted, that or exercised, that is also something that is decided by RBI. So what are the regulatory norms for RTGS? The maximum limit, the minimum limit. Okay, IMPS, or the same thing for IMPS and other medium of payments. What are the different norms and provisions, that is something which is decided by RBI only. Okay. Then custodian of forex, I told you that it is the only authority which is going to deal with forex. Then other than RBI, the authorized agents of RBI can deal with forex. Okay. So who are the authorized agents of RBI? It is actually all the commercial banks of the country. They are the authorized agents of RBI to deal with forex. Then it has a developmental role, that as apex monetary institution, it has the developmental role of promoting growth in the economy, promoting the employment generation, eradicating poverty, increasing financial literacy. All that is also the role of RBI. Okay. Then credit controls. Understand that credit control measures are used by RBI, firstly to ensure credit to different sectors of the economy, then to decide the interest rate that should be maintained in the economy. So RBI, through qualitative as well as quantitative measures that we are going to understand in detail, maintains the credit or controls the amount of credit in the economy. Okay. Other than this, you can also cite another functions. For example, RBI is an institution which has another role of publication of financial data. So, for example, financial stability report, that is also something which is published by RBI. Okay, so it has that function also. So all the major functions have been covered in these two slides. Okay. Now let us see some questions, direct questions. Again, direct only because you have understood these things properly. See, this appeared in 2012. The question is that the Reserve of Bank of India acts as banker's bank, and this would imply which of the following? Okay, bankers. If it is the banker's bank, that what does it mean? Other banks can retain their deposits with RBI. Yes, RBI is government's bank or banker of the government. That means that it is going to advise banks, it is going to advise government on financial issues. Then governments have to maintain the accounts with RBI. That is something that you studied. Now, if it is acting as the bank of the banker's bank, bank of the banks, then definitely banks can maintain their deposits with RBI. The next is, this is going to be an alternative. The next is RBI lends funds to the commercial banks in times of need. So we just saw that RBI is the lender of last resort. So it is the banker's bank. That means yes, it is going to fulfill that function also. Then RBI advises commercial banks on monetary matters. So I said that when RBI is banker's bank, then it it is also going to advise them on financial matters. So yes, this alternative, this statement is correct. Yes, it means, this would imply, if RBI is acting as the banker's bank, this would imply this also, this also, and this also. So which of the following statements are correct? All of the above statements are correct. So D alternative will be correct. Okay, so I think this is easy to configure. Okay. Next question. The Reserve Bank of India regulates the commercial banks in matters of liquidity of assets. Yes, liquidity of assets. Okay. So we just saw that Reserve Bank of India is going to act as the banker's bank. So it is going to advise banks on their financial matters. It is going to oversee how they are doing when it comes to capital adequacy norms, their their way of functioning, their how, whether they are maintaining all the accounts which are required on their part or not. So that is something that RBI is going to oversee. So liquidity of assets is one such requirement. So definitely it is going to oversee that also. Then we saw that it is going to oversee the branch expansion also, because that is something that the RBI is going to oversee, whether the banks are adequately capitalized or not, whether they are capable of expanding or not. Okay, so that is something which is going to be decided by RBI only. then mergers of banks, winding up of banks, so mergers, acquisitions. Now, if the bank has to survive or not, whether it has to be merged with other bank or it has to be acquired by other bank, that is also something which is going to be decided by RBI. Okay, so this also, this also, this also, and this also. Again, all four functions are actually done by RBI. So RBI regulates the commercial banks in all these matters, in all these areas. Again, 1, 2, 3, 4, all the alternatives are correct, and we just understood it. Okay, so when we were understanding the topic. Next question. Consider the following statements. The governor of RBI, this is from 2021, so last prelims. The governor of RBI is appointed by central government. So we studied when we were doing the most basic information on RBI that governor of RBI, the appointment is governed by RBI Act, where governor is appointed by PMO on the advice of finance ministry. This is the information that I told you. This was one of the basic information that we cover generally when we are going to cover economics course. So yes, this is correct. Okay, so yes, it is the central government. PMO is an office in the central government only. Then the next, certain provisions in the Constitution of India give the central government the right to issue directions to the RBI in public interest. Now, this statement seems to be a question of polity, but when you study RBI as an institution in detail in proper course of economy, then we are going to study about RBI Act 1934. Okay. Although many of the most important information I already told you. So it is actually through RBI Act that that actually is empowering the central government the right to issue the directions to the RBI in public interest. While Constitution of India is not dealing with this particular issue. So nowhere in the Constitution it is said that that central government has the right to issue directions to the RBI. No, central government has this right, but not by the Constitution of India, but by RBI Act 1934. Okay, so it is not by the Constitution of India. So this statement is incorrect. The first statement is correct. The next is the governor of RBI draws his powers from RBI Act. Definitely. Okay, so very appointment of the governor, the office of the governor is actually by this particular act. So all the powers are also by this act only. So this statement is correct. So 1 is correct, 2 is incorrect, and 3rd is correct. So now you can choose alternative here. 2 is incorrect, so you can eliminate option A and option B and option D. So this remains the only option which includes all the correct statements. Okay, so this way you can conclude that this is the answer. Okay, hello class. We have already covered in the previous part some of the most basic concepts of economy, and today we are going to cover another concept. First is money supply, then I will also talk about monetary policy. Okay, we will also see some functions of Reserve Bank of India, which is the central bank. But before that, because we have understood some of the basic concepts in the previous part of the series, we are going to attempt some questions which have appeared in previous year prelims examinations. Okay, so because we have studied national income and the related aggregates, we can go on attempting the questions on those topics. So this is the first question. This has been one of the controversial questions because of the language in the alternatives, but still we are going to attempt it. Okay. So national income of a country for a given period is equal to, let us see this question, let us attempt it. Okay, so yesterday you have studied about national income, and in the previous part I hope this is now completely clear to you that what is national income? Net national product at factor cost. Net national product at factor cost, where you understand the meaning of net, you also understand the meaning of national, and you also understand the meaning of factor cost. Okay, so net national product at factor cost, that is what we know as national income. Now let us see the alternative, that it is the total value of goods and services produced by the nationals. Now, if you recall the definition that we have covered, what was the national income? National income is net national product. Now, how this is different from GNP? We have studied about GDP, then we have studied about GNP. How GNP was different from GDP? It accounted for all the final goods and services produced in the domestic territory, and it accounted for all the production by the nationals of the country. Okay, then how GNP is different from NNP, which is actually the national income? Because national income is going to be net, it is not going to be gross. Okay, so here you see that total value of goods and services produced by the nationals. It seems to be the correct option, but it is not the correct option. Because why it seems to be a correct option? Because the production is by nationals. But if you recall, I gave you the definition where it was said that it is a money value of final goods and services and not the total goods and services. Okay, it's not the total value of goods and final goods and services. So that is why this option is going to be incorrect. Okay, the second is sum of total consumption and investment expenditure. Now, this alternative is again not very clear whether it is on the domestic territory or whether it is on the by the nationals of the country. That is why we can't arrive to a conclusion that it is national income or not. So this second alternative is also not complete. It does not give you the complete picture about the definition that we already have of national income. Okay, so this option can also not be correct. Then the third is sum of the personal income of all individuals. Okay, now if you have seen the previous part that that we had when we studied about GDP and GNP and related aggregates of national income, you saw that there must be a clarity that the production is taking place by the nationals of the country. Okay, now only one option was there where production is by the nationals of the country, but it is talking about total value of goods and services and not the final goods and services. Okay, that is why we did not opt for this particular option. We can not opt for this particular option also because again the information is not very complete. Okay, it is a sum of personal income of all individuals. What about domestic income? Whose individuals from domestic territory or outside the domestic territory? That is also not clear. Okay, so this can also not be your answer. Now the last is money value of final goods and services. Because see, understand, one way of attempting the questions in prelims is by way of elimination. So you are 100% sure that these three options are not the correct options. Then one of them must be the correct option, and that is why D will be the answer. So this way also you would have attempted this particular question, and many of the questions in prelims examination you will be able to attempt only by elimination, or only by method of elimination. So this is one way of doing the questions in prelims. Okay, because you are sure that this is not the answer, because it is not the total value, it is the total value of final goods and services produced, okay, by the nationals. Then this also cannot be the answer. This also cannot be the answer. D will be the answer, but let us see the alternative here. It is the money value of final goods and services produced. Money value of final goods and services produced. Okay, so this particular part actually is corresponding to the definition that we have already covered of national income. So yes, it is the money value of final goods and services produced. But why did I say in the starting itself that this has been one of the controversial question? Because the complete definition would be that it is the money value of final goods and services produced by the nationals of the country. Okay, so although this option also is not complete, but you can say this is the answer if you have to choose among these four alternatives, because others cannot be the answer. Okay, so the most correct version of this statement would be that it is a money value of final goods and services produced by the nationals, but that has not been given by UPSC. Still, if we have to conclude that which particular alternative is correct, then we will go with D. Okay. And according to UPSC's answer key also, this was the option. Although you know, because now you have the basic knowledge about the aggregates related to national income, you know that it will be the money value of final goods and services produced by the nationals. Okay. By the, see, sometimes there can be one or two questions which where you can raise doubts, or you can, they can be controversial, but still, when UPSC is giving you certain option to be the correct option in answer key, then it means that yes, that a particular option has the merit over other alternatives, and this is very much visible in this case also. Okay. Okay, let us see the second question again from this section that we have already covered. There have been various questions from the section that we have covered, but those were very easy and direct, and that is why I have chosen these two. Okay. Now, this is not basically on the concept of national income aggregates, but this is based on the common understanding. The question appeared in the year 2015. Okay. And UPSC has this habit of asking the questions, certain questions on datas, on the pattern that you can find in certain datas. So this is one such question. Okay. Read the question. With reference to Indian economy, consider the following statement. The rate of growth of real gross domestic product has steadily increased in last decade. Okay. Now, in the previous part, we have studied about real GDP and nominal GDP. Okay. There you saw that real GDP will increase only when there is increase in production. Okay. While nominal GDP, you have learned that may increase just because of increase in prices. Okay. So in previous part, you have seen an illustration where I provided the data on a table, and I have shown that how nominal GDP can go on increasing even when there is increase in prices only and there is no increase in production. Okay. It may also happen that production has actually decreased, but because of the increase in prices, nominal GDP has increased. Okay, so let us see the first option. The rate of growth of real gross domestic product has steadily or continuously increased in last decade. Okay, increase in last decade. Now the question appeared in 2015. Last decade can be measured from 2015 to 2005, or it can be 2001 to 2010. I am not just going to dwell on that part very much, because this is not going to change the answer. Okay, let us see this. The rate of growth of real gross domestic product has steadily increased in last decade. That means in last 10 years, or in last decade from 2000 to 2000, let us consider that to be a decade in question. How can it happen that India has undergone or India has faced global financial crisis also in the year 2008-9? Is it possible that the real production, the increase in production, the production has continuously increased every year? No. Even if you do not remember the data of GDP for every particular year, you will be able to conclude that because there have been global financial crisis and India has to a good extent suffered from that very crisis, then production must have decreased. Production must have decreased. And that is why the fiscal stimulus was provided. Okay. So if you go by the data in the year 2008-9, or before that, there have been 9 to 9.2% of GDP's growth rate. Okay. But after the crisis, it came down to 6 to 7%. 7%, around 7%. So this GDP came down, GDP's growth rate came down only because of decrease in production, because there we were talking about real GDP. Okay, that means real GDP will increase only when there is increase in production. It can't increase because of increase in prices, because we are going to measure it by considering any particular year to be the base year. Okay, so this statement is incorrect, because the rate of growth of real gross domestic product has not steadily increased in last decade. Actually, there have been crisis also, and mainly because of the crisis, real GDP decreased actually. Okay, now let us see the second option. The gross domestic product at market price. Okay, the gross domestic product at market price in rupees has strictly increased, has, I'm sorry, steadily increased or continuously increased in last decade. There is a typo. Okay, it is not strictly, it is steadily. So the gross domestic product at market price has continuously increased in last decade. Now, what is gross domestic product at market price? This, you know that this is the nominal GDP. Nominal GDP. Now you have seen that nominal GDP can increase because of increase in prices. Okay. So again, this question seems to be based on certain real data, and candidate may get scared just because he might not be able to recall the exact data. But this is not the question to skip, because this is actually not a question on data. This is actually a question on the conceptual understanding of these two terms, that is real GDP and nominal GDP. Now, even if you do not have the data of nominal GDP, that is gross domestic product at market price, okay, then also you can conclude that market price or the prices of the product must have continuously increased. They have increased, and that is why nominal GDP also must have increased in every single year, and that has been the case actually. Okay, so when it comes to this particular question, alternative 2 or statement 2 is correct, and that is why this is the answer, because first statement is not correct and second statement is correct. So it is B alternative which is the correct answer here. Okay, so these two questions I have chosen just to explain. There have been other questions also on the concepts that we have covered, but they were very direct questions, and these were actually two good questions from the section that we have already covered. That is, I have selected these two. Okay, okay, now let us move on to some other basic concepts, and again these are basic as well as important. Okay, important from PLIM's point of view. The first such concept is money supply. Okay, now every single year I have seen that UPSC has been touching on these particular topics, and that is why I have selected these topics. Okay, now let us define money supply. How do we define this? So in most simple terms, that it is called the total stock of all the types of money. Total stock of all the types of money will include currency as well as deposit money, means the money that people have in their hands and also the money that they have deposited, held by public at any point of time. So what is money supply? Total stock of money held by public. Now this word is important. When we are saying public, we are including all the economic entities except banks and the government. Okay, so we are not going to include these two bodies, because in our definition of the public, because these two bodies are actually the creators of money. If we want to measure a stock variable, then we must keep a tab on those sources which are continuously sending that particular variable. Okay, creating that particular variable. So banks and governments are actually the creators of money. Banks through credit creation and government through printing via RBI actually creates money. So that is why we are not including banks and government in our definition of public. Okay, so it is a total stock of all the types of money, that is currency and deposit money, held by public at any point of time. And now the term public included all economic entities except the government and the bank. Okay, so what this money supply actually signify? This money supply, you can say, tells about the liquidity, the total liquidity in the economy. Total money in the economy can also be called total purchasing power in the economy. Total purchasing power in the economy is signified by money supply, or MS. Okay, so we are going to use this short form, that is MS, money supply. Okay, it tells you about the total purchasing power in the economy. Now, purchasing power is something which is going to determine or decide the demand in the economy. So you can say that money supply also decides the total demand in the economy, because it is deciding the purchasing power. Okay. Now there are different kinds of monetary aggregates, and that is something which is important from prelims point of view. These monetary aggregates are going to be named as like M1, M2, M3, M4, and these aggregates we have to know because they are important from prelims point of view, and there have been various questions also. Okay, the first such monetary aggregate is M1. Okay, so money supply, which I said is something which signifies the total purchasing power in the economy, will include all the currency notes and coins with public, where public excludes two entities, that is banks and governments. Now, this money supply, as I said, that it is going to include the currency notes and coins, will have certain assets of money, or you can say certain currencies, certain part of money, that money will be readily liquid and other will be less liquid. And that is something that we are going to understand before we come to monetary aggregates. Okay, so let us see that. Understand, when we talk about bank accounts, so how many kinds of bank accounts are there? Okay, this basic understanding is required for understanding that particular thing. So you have savings accounts, yes, saving account. Then you have current account. Then you have fixed deposit account, and then recurring deposit account. Okay, so these are the four or three kinds of accounts that you have. You may say that there is demat account, but that is not a bank account, that is a trading account. Okay, so these are three kinds of accounts. Okay, just for your revision, because this topic is related with the topic of monetary aggregate. Now, in saving accounts, this account is mainly for whom? This account is mainly for households. Yes, this is mainly for households. And this account, current account, is mainly for businesses. Yes. And FD and RD is for both household as well as businesses. Okay. What about the restrictions that you have in savings account? Are there any restrictions with regard to transactions, especially with regard to the withdrawal? There are certain restrictions. Okay, some restrictions are there. Some restrictions, or you can say relatively low restrictions, because number of transactions are fixed. More than that, then if you go for more than that number of transactions, then you have to pay certain amount to the bank. In current account, you don't have any restrictions, so there are no restrictions. Okay, and in FD and RD, yes, there are restrictions. So relatively high restrictions, because if you have deposited certain money in form of fixed deposit, then you cannot withdraw it before the maturity period, and if you withdraw it, then there will be penalty. Okay. Now, what about the interest rate? The interest rate in saving account is relatively low. Okay, because why I say relatively low? Because in current account there is no interest rate, zero interest rate. They are relatively low in comparison to fixed deposit and recurring deposits. So here you have relatively high interest rates. So interest rates here in savings accounts relatively low, in current account zero, and in fixed deposits and RDs relatively high interest rates. So what I can say here is this, that in savings account when you deposit certain amount, then you can withdraw it on demand. Yes, you can withdraw it on demand, and that is why I can call it demand liability, or you can say demand deposit. Yes, demand deposits. And from bank's point of view, it is demand liability, because on demand it has to pay the amount back. And I can also call it time deposit, because there are certain limitations with respect to the transactions of money, especially the withdrawal, because certain number of transactions are allowed in a certain month or certain period of time. Okay, so that is why I can also write it time deposit. Okay, what about current account? No restrictions with regard to the withdrawal, so it can be withdrawn anytime. So it can be withdrawn whenever the demand for withdrawal is made, and that is why here it is mainly demand deposits. Okay, and this can be withdrawn only with the maturity of time, and here you can say that this is time deposit. Yes, so in current account there is demand deposit, in FD and RD there is time deposit, and in saving accounts there is demand deposit as well as time deposits. Okay, now if I just add up these demand and time deposits of saving accounts, demand deposits of current account, and time deposits of FD and RD, don't you think I get the total bank deposits? Yes, total bank deposits. Getting it? Total bank deposits. This is DD plus TD, then plus DD plus TD. Okay, that is demand deposit plus TD plus DD and TD. Now, if I exclude the interbank deposit, that means the deposit of one bank in another bank, then what I'm going to get will not be the total demand and time liabilities. Here, total bank deposits will be actually total demand and time liabilities. Okay, total demand and time liabilities. Now, if I exclude the interbank deposits, then this total bank deposit will become total public bank deposits, and this total public bank deposits is called net demand and time liabilities. Net demand and time liabilities. So how do we get net demand and time liabilities from total demand and time liabilities? We are going to exclude interbank deposits. Okay, deposits of one bank in other bank. So this concept of NDTL is very important. Net demand and time liabilities. Okay, now understand that when we are going to see different kinds of deposits, don't you think we can compare different kinds of deposits with respect to this concept called liquidity? Okay, so if I ask you that demand deposits and time deposits, if you have to choose which is more liquid, which is more liquid, whether it is demand deposit or time deposit, it will be easy to answer here, and you can say that demand deposit is more liquid. What is the meaning of any asset being liquid? If any asset is more liquid than the other asset, that means that asset can be more readily converted into money. So you can get that money in form of cash readily. That will decide its liquidity. When I say that gold is more liquid than land, that means gold can be converted into money more readily than the case with land. Than is the case with land. Okay, so that makes gold more liquid than land. Same way, demand deposit is more liquid than time deposit. Okay, so if any asset is very liquid, that means it can be readily converted into cash. Okay, so that is why demand deposit is more liquid than time deposit. Now, other than banks, there are post office banks also. So other than commercial banks, you have post office banks also. And these post office banks also provide the facilities for deposits. So there also you can make savings accounts, saving deposits. There also you can make time deposits. Okay. Now, in comparison to commercial banks, post office banks are not able to provide those value added services. Okay. Secondly, post office banks do not provide or do not lend also. So in that way, they are different from commercial banks. Also understand that post office banks are actually governmental undertaking under the department, certain department of the government. Okay, Department of Post under the government of India. While commercial banks, there are public sector banks and private sector banks. So when in case of public sector banks, government is the majority shareholder but not the full owner. But in case of post office banks, government is the full owner. When you deposit any particular money in, say, for example, SBI, that is State Bank of India, which is a public sector bank, that is not a government money. Okay, that is not the government money, that is the money held by public in State Bank of India. So in that case, that is a liability on State Bank of India. But when you deposit money in post office banks, that is a kind of lending to the government. That is a kind of lending to the government because now that is going to become part of public accounts of India. Getting it? The money deposited in post office banks. Okay, so for example, post office releases certain securities, National Savings Certificate, Kisan Vikas Patras. All that is a kind of lending to the government because those securities are the securities of the government of India. And if they are being bought by the public, then it is the public who is going to claim interest on those securities from the government. Okay, so similarly, the saving deposits, the time deposits in post office banks are kind of lending to the government. But still, those will become part of money supply. But if you compare the demand deposit of post office, it is going to be less liquid than the demand deposit of banks. And similarly, time deposits of post office banks is going to be less liquid than the time deposit of banks. So because of less value added services, because how they are going to function, how they actually function in comparison to the swift functioning that you have in case of private commercial banks. Okay, so you just saw different kinds of accounts. You also understood the concept of net demand and time liabilities. You also understood how there are different components, there can be different components of money supply that is going to become part of money supply but may differ in terms of liquidity. Okay, so DD is going to be more liquid than TD. Now, because you understand all the components, now we can move on to the concept of monetary aggregates. And here you have M1 equals to C plus DD plus OD. There are 4 monetary aggregates, M1, M2, M3 and M4, and we are going to cover one by one. Now, M1 equals to C plus DD plus OD. Understand, what is the meaning of C here? C means currency notes and coins with public, and public would mean the same thing, that is all the economic entities excluding the government and banks. Then what is DD? Demand deposits with banks. And what is OD? OD means other deposits with RBI. So many people, for example, former RBI governor, many institutions, for example, IMF, and other international financial institutions, and many quasi-governmental bodies maintain reserves or accounts with RBI. So that is something that we call at other deposits. Okay. So M1 is that component of money supply which is going to include currency notes and coins with public, then demand deposits in banks, then other deposits. That is other deposits in RBI. Okay. Now there are other components of money supply also. For example, there is time deposit. Then there are other deposits in post office banks. But don't you think that this particular monetary aggregate is going to show, is going to cover all that money which exists in economy in most liquid form? In most liquid form. Okay, currency notes and coins with public as well as demand deposits and other deposits that institutions, then certain people and certain quasi-governmental bodies maintain with RBI. All these kinds of money is going to be readily available and can be converted into cash anytime. And that is why I'm saying that this M1, that is this monetary aggregate, is the most liquid component of money supply. Okay, so M1 is the most liquid component of money supply. For this reason, it is also called narrow money. Narrow money. Okay, so M1 is that component of money supply which is most liquid, although it is not going to give you the complete picture, the complete idea about the money supply in the economy, but it is going to give you an idea that what amount, what percentage, or what section of what component of money supply is most readily available for use. Okay, that is liquid form, the most liquid component of money supply. Okay, this is one of the monetary aggregate which is practically used to have an estimate of the most liquid component of money supply. Okay, it is called narrow money. Okay, let us move on to the next monetary aggregate, that is M2. Now M2 is M1 that we have already covered. M1, C plus DD plus OD, plus saving accounts deposits with PO banks, post office banks. Saving accounts deposits with post office banks. Understand, M1 we have already covered, that is C, currency notes and coins with publics, then demand deposits, banks, then other deposits. So it will be, M2 will be C plus DD plus OD plus saving accounts deposits with banks, post office banks. First of all, saving accounts deposits with post office banks, this is the extra element that you have in M2, is going to be less liquid than all the components that you have in M1, that is C plus DD plus OD. So the first conclusion that you can derive from M2 is this, that this is going to be less liquid than M1, because what is being added in M2 other than M1 is going to be less liquid than all the components that you have in M1. So that is why M2 is going to be less liquid than M1. So which is more liquid? M1 is more liquid than M2. Okay, this is the first information. Now the second information is this, that whatever is being added in M1 to get M2 is of negligible amount. So it is insignificant in the sense that the size of saving accounts deposits with PO banks in India is negligible when you compare it with saving account deposits with banks. So you have already covered saving account deposits in M1, then saving account deposits with PO banks is not going to make much difference in this monetary aggregate. And that is why, although M2 as a monetary aggregate exists in India, but practically it is insignificant, not very relevant. Not very relevant. Okay. M1 is a relevant monetary aggregate because it gives you the idea of most readily available money supply. Okay, that is the most liquid component of money supply. But M2 is not very relevant monetary aggregate because whatever is being added is insignificant. Okay, and M2 is going to be less liquid than M1. Then M3, third monetary aggregate. So what we are doing here is M1 plus time deposits. Okay, so in M1 you had C plus DD, that is demand deposits, plus other deposits, and you added TD, time deposits, to get M3. Okay, again, very important monetary aggregate. First of all, this is going to be less liquid than M2. Okay, so the most liquid so far has been M1, then M2, then M3 is going to be less liquid than M2 because time deposit is getting added in M1 to get M3, where there was no time deposit in M2. Okay, so fixed deposits or recurring deposits have certain maturity time, and before that they cannot be converted into money, and that is why TD is less liquid than DD. Okay, so which is going to be most liquid? M1 is going to be most liquid, then M2, thirdly it will be M3, because now M3 is going to include time deposit. Now the second thing that you need to know about M3 is this, that other than being the least liquid monetary aggregate that we have studied so far, M3, don't you think, is going to cover almost every significant component of money supply. It is going to cover all the currency notes and coins with public, then demand deposits, then other deposits, and then also time deposits. So nothing is left, nothing much is left uh, other than what we have already covered in M3. So that is why this monetary aggregate is very important and very relevant and called the broad money. Why it is called the broad money? It is called the broad money because it is going to cover almost every important component of money supply of the country. Okay, so if you want to know about the total money supply in the country, it is actually the M3 that you can look upon to have an idea. Okay, so broadly it is going to cover every component of money supply: currency notes and coins with public, demand deposits, other deposits, time deposits. Okay, so that is why it is called broad money, and practically it is very much significant, very much used for estimating the money supply in the economy. And when you talk about money supply in the economy, you actually talk about M3, this particular monetary aggregate. Okay, so you learned how M3 is the least liquid among M1, M2, M3, and how this is the most relevant when it comes to having an estimate of total money supply in the economy. Okay. Lastly, there is M4. Okay, so what you are adding in M3 to get M4? Total PO deposits. So you have already added saving account deposits in PO banks in M1 to get M2, and that you have already understood is not going to make much difference in M1, and that is why M2 as an aggregate is not very relevant. Similarly, total PO deposits, if they are being added in M3, is not going to make much difference because this is going to include savings accounts, that is demand deposits with banks, as well as time deposits with PO banks. Okay, and it is not going to include national saving certificates or Kisan Vikas Patras. So that is not included. That is another important information that we need to keep in mind. Okay, so M4 seems to be a component of money supply which should be taken to have an estimate about the total money supply in the economy, but again is something which is not much practically relevant. Not much relevant because what is being added in M3 to get M4 is not very significant. Okay, not very significant. Not very significant. So practically, which two aggregates are used in the economy to have an estimate of money supply? Firstly, it is M1 to know about the most liquid component of money supply, and then M3, which is also called broad money, to have an estimate about the total money supply in the economy, the total purchasing power in the economy. Okay, so M1 and M3 are most practically used. M2 and M4 are not practically used very much, because whatever is being added in M2 and M4 to get these aggregates is not very significant. Okay, so these are four kinds of monetary aggregates: M1, M2, M3, and M4, where M1 and M3s are practically relevant. M2 and M4 are not much practically relevant. Then M1 is called narrow money, because in narrow sense it is going to have fair estimate of the most liquid component of money supply in the economy. And M3 is called broad money, because it is broadly covering every component of money supply in the economy. And that is why whenever you have to estimate money supply in the economy, you look to this monetary aggregate to have an idea. Okay, and if you arrange them, then M1 in liquidity, in decreasing order of liquidity, M1 is the most liquid, then M2, then M3, and then M4. Okay, this is the least liquid component, these least liquid aggregate, and this is the most liquid aggregate. Okay, so this way you cover all the monetary aggregates that you have: M1, M2, M3, M4. Okay, UPSC has been asking question on monetary aggregates, money supply, and it has also asked to arrange different components of money supply in increasing or decreasing order of liquidity. So I think now this is completely clear to you. Okay, now understand these two terms that you need to understand here. The first is stock variable, and the second is flow variable. Okay, stock variable and flow, one is different from the other, because in stock variables you can measure these variables at a, or you can say, when you talk about stock variable, you can measure these variables at a point of time. So for example, you have to measure, for example, if you are asked with this question, that what is the difference between debt and borrowing, then this is actually the difference, because debt is something which is a stock variable. It can be measured at a point of time. You can ask that what is the public debt of India today, but borrowing is a flow variable. This is covered, or this can be measured over a period of time. For example, you can't ask a question that what amount government of India has borrowed today, or what is the total borrowing, what has been the total borrowing of government of India over, say, in 2019 to 2021. That is the question that you can ask. Okay, so when I say stock variable and flow variable, why I'm talking about this, because when you consider money supply as a concept or as a variable, where would you put money supply, in stock variable and flow variable? Then you can say that money supply is a variable which can be measured at a point of time. So now you can just visit RBI's website and can come to know that on March 17th, 2022, or on 1st April 2022, this is the total M3 in India, that is third monetary aggregate that we have covered, and that will give you the idea about total money supply in the economy. So money supply is actually the stock variable, that it can be measured at a point of time. While we have already covered the concept of national income, that is net national product at factor cost, you must know that that is a flow variable. Okay, so you can't ask a question that what has been the national income of India on 17th March 2022. You have to see that what has been the national income of India in 2019-20 or 2020-21 over a period of time. Okay, in order to understand this, consider this particular difference that we have. For example, the difference between knowledge and learning. Can I ask you that what has been the learning, or what has been your learning on this particular moment of time, or this particular point of time? No. Although I can ask that what has been your knowledge, or whatever knowledge you have gathered at till this point of time. Okay, but when it comes to learning, this can be measured over a period of time only. Okay, so debt is a stock variable while borrowing is a flow variable. Money supply is a stock variable while national income is a flow variable. Then knowledge is stock variable while learning is a flow variable. Okay. Now this is something that we need to keep in mind. So money supply being a stock variable can be measured at a point of time, and these measurements are provided by RBI in its website. You can go and look the different monetary aggregates. Look at the different monetary aggregates released by Apex Monetary Authority in your country, that is central bank. Okay. Now another very important concept: reserve money. Okay, this is going to be the base money. After that, that base money multiplies in different times to become money supply in the economy. Okay, so what is reserve money? This is signified by M0. So we have covered M1, M2, M3, and M4, and you can say this is the last monetary aggregate, but the most important monetary aggregate. Reserve money is going to decide, or is going to be crucial in determining the money supply in the economy. Actually, this is the base money, and this base money multiplies different times to decide the total money supply in the economy. So you can say that this is the primary money. Primary money. So this can be called base money as well as primary money. It can also be called, it is also called, you can say, high powered money. High powered money. Okay, high powered money. Now see the different components. M0 equal to C plus R plus OD. C plus R plus OD. When we are talking about reserve money or base money, and then we just try to break down the components here. Here it will be currency, notes and coins with public. But now this time the term public is not going to exclude banks. It is not going to exclude banks. So the only entity which is going to be excluded from the term public is the government. Okay? When we are talking about base money and primary money, we are just going to exclude that entity which is responsible for creating that money by printing. Okay? So whatever money that banks generate, they do not generate it by printing the money. So government is the only entity which generates money by printing the money via RBI. But bank do not do it, although banks also the creators of money, but they do not create money by printing. Okay, so reserve money, that is base money or high powered money or primary money, will have currency, notes and coins with public, and here public means all the economic entities except bank. Then R, that is cash reserves of bankers with RBI, that is good example is CRR, cash reserve ratio. Then OD would mean the same thing, that is other deposits held in RBI by institutions like IMF, then people like former governors, then other governmental bodies. Okay, so this is M0, that is primary money or base money, high powered money, okay, or reserve money. Now this reserve money will become the very important determinant in deciding about the total money supply in the economy. Okay, so what is the relation between M0 and MS, that is the total money supply in the economy? That is something that you need to understand. Okay, so relation between money supply, that is MS, and M0. M0 is what? Base money or reserve money or high powered money or primary money. Okay, so this is what we need to understand. Very important concept, and UPSC has been asking question on this particular concept also. So this is the relation. MS equals to small m multiplied by M0. That is money supply equals to small m multiplied by M0. You already know MS, that is money supply. You already know M0, that is primary money. What is small m? Small m is money multiplier. Money multiplier. Okay, money multiplier. Okay, money multiplier. Now understand that I told you that primary money is going to be an important determinant in deciding the total money supply in the economy. But now you have another variable here, that is small m, which is called money multiplier. So it is actually the money multiplier and primary money which is going to decide the total money supply in the economy. So money supply in an economy will depend upon money multiplier and reserve money. But now reserve money is also something which is a stock variable, can be measured at a point of time. But what about money multiplier? That is something that you need to understand. Money multiplier is the relation between money supply and reserve money. Then what are the factors that are going to decide or determine money multiplier, or it is going to be affected by which factors? That is something that becomes important to understand. So money multiplier depends upon credit creation capacity of the banks. Credit creation capacity of the banks. Okay, credit creation capacity of the banks, that is something that is the most important thing that you need to understand here. Okay, so let us understand it, and then we will attempt the questions. Okay, now see, I said that money multiplier, that is a small m, is going to depend upon credit creation capacity of the banks. And this credit creation capacity of the bank is going to depend upon two factors. The first is monetary policy, and the second is banking habits of the people. Banking habits of the people. Okay? Banking habits of the people. This is important. And this is something that we are going to understand through an illustration. Okay, so for example, there is an individual X. Okay, so this is Mr. X who was given, say, 100 rupees of note from reserve money, that is high powered money, base money, because Mr. X indulged in certain kind of transactions with the government. Okay, so Mr. X got 100 rupees, and that was part of M0. Then Mr. X might keep it under his pillow, might keep it over the fridge, or he might think of depositing this money in his bank, SBI. Yes? So this 100 rupee went to SBI. Now SBI is under statutory obligations to maintain certain reserves with RBI in form of CRR. Then it has to maintain certain reserves with itself, that is SLR. And all those are credit control measures used by Apex Monetary Authority to control the credit in the economy, to control the money supply in the economy, and that is something which is being decided by monetary policy. Okay, so Mr. X could have kept that 100 rupee note under his pillow, but choose to deposit in SBI because of his banking habit. And now SBI has to take out certain part of that money in form of CRR, which has to be kept in cash form with RBI, and SLR that has to be maintained with itself in form of cash, gold, and government securities. That is something that we are going to cover later. And that is something which is being decided by monetary policy. Now, let us say that the total such requirements is 20%. So, out of 100, SBI has to keep aside 20 rupees, and now the rest of the 80 rupees can be given to Mr. Y in form of loan. Okay? In form of loan. Getting it? Now, Mr. Y again can put it under his pillow, or will do certain business, will do certain other transactions. Say, for example, he spent 20 rupees in certain transactions, and with the rest of 60 rupees, he maintained that in other bank, that is SDFC. Okay, getting it? Similarly, SDFC will keep aside 20% of 60 rupees to meet these statutory requirements. That is 20% of 60 would be 12, and then can go on giving 48 rupees to person Z, and person Z can go on doing the same thing. Okay, so for example, you took 100 rupees note which was part of primary money, and that became 100 plus 80 plus 60 plus 48 in the economy because of two factors. The first is that these people, instead of choosing to put that money under their pillow or um, in their bedroom closets, choose to deposit in banks, and banks actually gave those money in form of credit to different people. That means credit creation is happening by banks here. Okay, so this 100 rupee note, which was part of money, primary money, generated this much of total money supply in the economy. Getting it? Now, which factors are determining that to what extent primary money would multiply to become money supply? These two factors, that is monetary policy and banking habits of the people. That means if monetary policy would have required SBI to keep aside only 10% of this total demand and time liabilities, then SBI would have given 90 rupees to Mr. Y, or would have created 90 rupees of credit to different individuals. Okay, similarly, SDFC would have also have created more than 48 rupees of credit to the individuals. So in that case, if monetary policy would have been more facilitative to the credit creation, then more money supply would have been there in the economy. Okay, similarly, if these people are not going to deposit money in the banks, that is, if they don't have the banking habits, they don't have these kind of banking habits, then also 100 rupee, which is a part of primary money, will not give rise to this much of money supply in the economy. Okay, so this way you saw that this small m, which is a money multiplier, is deciding the total money supply in the economy from the base money, and that is being decided mainly because of this factor, mainly due to this factor, that is credit creation capacity of the banks. And this credit creation of the bank capacity of the banks depends upon two factors, that is first monetary policy, and the second is banking habits of the people. Okay, and this is the illustration to understand the whole scenario. Okay, so you understood that how money supply in the economy is going to be determined firstly by the reserve money, but mostly by the money multiplier, which is going to depend upon credit creation capacity of the banks. And now this credit creation capacity of the banks depends upon two major factors. The first is monetary policy, and the second is banking habits of the people. Okay, banking habits of the people. Okay, now because we have understood these basic concepts, we can go on attempting the questions. For example, this question appeared in the year 2020. So for example, this question says that if you withdraw 1 lakh rupees in cash from your demand deposits account and account from your bank, accounts from your bank, the immediate effect on aggregate money supply in the economy, MS. MS would mean what? M3. Yes, I have already told you. So the immediate effect on the aggregate money supply in the economy. So there was 1 lakh rupees in form of demand deposits. Getting it? That has been withdrawn. Then the immediate effect on aggregate money supply. Demand deposit is in M1. And what is in M3? M3 includes M1 plus TD, time deposits. So if demand deposit has been withdrawn, then it has been converted into C, that is currency notes and coins with public. But M1 includes C also, and M3 also includes C. So don't you think that there will be no change in the money supply, because money supply is M3 equals to M1 plus TD. And what is M1? M1 equals to C plus DD plus OD. You just learned about it. And then TD. Getting it? So what is being done in the question? Withdrawing 1000 rupees of cash from demand deposit, that is this. But when you withdraw 1000 rupees of cash from demand deposit, you just convert it into C. Yes, because this C means currency notes and coins in public. So if I withdraw 1 lakh rupees from my account, I will have it in my hands. But that is also part of M1, and M1 is part of M3. So money supply will not change. Okay, so I will not even look into all the alternatives. I will just choose the alternative here, that which says that there will be no change in the money supply, because if I am completely thorough with this, I have completely covered all the concepts, the relevant concepts here. I am just going to look at the question and will say that, okay, the question is saying that if I convert this to this, will there be change in money supply? No, there will not be any change in money supply, because both components are actually from money supply only. Okay, from money supply only. So the correct alternative here is that there will be no change in the money supply. It will not decrease, it will not increase, it will not increase by more than 1 lakh rupees. It will just remain unchanged, because DD is getting changed. 1 lakh of DD is getting changed into 1 lakh of currency notes and coins with public. Okay? See, when you understand these concepts in UPSC syllabus now, then UPSC is not going to ask it can't frame very tough questions. It does not frame very tough questions. So this was one such question where if you have completely understood the basic concepts, then it will not be very difficult to answer. Okay. Next question. This appeared in 2021. The money multiplier in an economy increases which one of the following? Okay, see, again the direct question. So we studied that MS, that is money supply in the economy, would be small m, that is money multiplier, multiplied by M0, that is reserve money. So money multiplier is M, small m, and you just came to know that this is depending upon credit creation capacity of the banks, which depends upon two factors. First, monetary policy, and the second is banking habits of the people. So money multiplier in an economy increases with which of the following? Increase in the cash reserve ratio. Is it increasing in the cash reserve ratio? No. When we are going to study about cash reserve ratio, you will see that it is going to decrease with cash reserve ratio. But even if you have not studied about CRR and you have followed me in that illustration, then I told you that if monetary policy would have been more facilitatory in credit creation, then if there would have been lesser statutory requirements of maintaining reserves with RBI and with bank itself, then there would have been more credit creation. That means there would have been more capacity of the banks, a greater capacity of the banks to generate credit. Okay, so no, it will not increase with increase in cash reserve ratio. It will decrease with increase in cash reserve ratio. Okay, increase in the statutory liquidity ratio. No, same is the condition with SLR also. So this will also not be correct. Increase in the banking habits of the people. Yes, this is the correct alternative. Still looking to the fourth alternative. Increase in the population of the country. Again, this is not going to determine the money multiplier, because if they don't have that banking habits, there is not going to be any effect in just by increasing the population. Okay. So these are just opposite alternatives, opposite to what is required, what the question is asking. Third alternative is correct, and the fourth alternative does not have any direct relation with money multiplier. Okay, getting it? So even if you have not studied these credit control measures, you are able to answer it just by understanding the relation between money supply and primary money. Okay, so I think this is clear. Okay, now we are going to study another concept and the topic. Again, I'm just going to focus on the most important things, important from prelims point of view. That is why I'm not just going to deal those topics in very much detail, because these topics also have certain uh, component which is descriptive and more relevant from mains point of view. Okay, so just focusing on prelims now.